Do most traders fail? Well, the stats say that 90% of traders fail, but let's take a look at who we're really talking about. How do you define trader? Would you consider someone who funds a small trading account with $200 and uses an untested trading strategy a trader? I don't think that person can compare to someone who's using a positive expectancy trading strategy with sound money management, as well as having a grip on the psychological demons that trading can evoke. And until we can get a determination of which type of person that stat refers to, I think it's a number that we should generally ignore. A more relevant stat, if we could get it, is the number of people who claim trader on their income tax. And of that number, how many make a decent living from trading? How many make a good living or even become wildly successful? How many who are currently successful end up blowing up their trading accounts and just changing careers? Trading is fraught with risk, and traders have to be vigilant if they're going to avoid the fate that falls so many other people. And the first step on this trading journey is to be aware of the potential pitfalls ahead. And one major pitfall that we see at Netpicks, now remember, we have thousands of people around the world that use our trading systems. And that pitfall is being undercapitalized. And we've seen those that have really good potential just flame out because they did not have the appropriate levels of funding. Now, undercapitalization means that you don't have enough capital to ride out the runs of poor performance in order to see your trading strategy's edge play out. A strategy with a win rate of 66% over a set of 100 trades could have a loser every third trade. And the historical probability of a strategy is a guarantee of neither the future distribution of winners and losers nor the future win rate. Let's take a look at this chart here. This shows the basic relationship between the amount of risk a trader is willing to take on each trade and the number of losing trades they are able to withstand up to the point where their starting capital has been depleted. Now, this does not take into account fees and commissions, and it ignores margins. Now, a more realistic model would include these. It would also include a more likely situation where a trader experiences a slump in their win rate or a win-loss ratio rather than simply the losing streak that it assumes. The curve is the same, but if you also factor the number of trades you take per day, it gives you a good idea of how long you'd last in this sort of scenario. What the chart does show is that the relationship between the number of trades and percentage of starting capital risked per trade is exponential. The number of trades dramatically reduces when risk per trade is increased from 1% to 2% and beyond. And the relationship can be calculated like this. Now, the second formula, it allows you to input your expected risk per trade in dollars along with the amount of risk you wish to take per trade, and then calculate your required starting balance. And if you know where you stand, you're far more likely to be appropriately capitalized. And because you see the value of it, you'll also be more likely to adhere to your risk and your trading plan. Let's look at the ES, for example. A losing trade on a 2-lot in the ES, risking 2 points per trade, will cost you $200, and that's excluding the fees and the commissions. If a trader is willing to risk a maximum of 2% per trade of their starting capital, they must deposit a minimum of $10,000 to trade this particular product and strategy. Many people start with much less than this, and therefore they end up risking a much greater percentage of their starting capital. Is it any wonder that so many traders struggle? An important point here is to distinguish between the amount of risk per trade as a percentage of starting capital and the amount of risk per trade as a percentage of current account capital. Ideally, a trader would have enough capital and therefore sizing flexibility to implement the latter, but this is often not realistic for traders with smaller trading accounts. Now, there's another crippling side effect to undercapitalization, which often fails to be addressed. Let's say the trader does their homework and they figure out that they need $10,000 to trade 2 lots in the ES using a strategy that risks $200 per trade. So they scrape together the money from their savings and loans from family or friends. It's not ideal, but they have to if they want to trade. And they only realistically have $250 per month of their income, which they could use to supplement their trading capital. So it would take them 40 months to save that $10,000 that they need. And because they cannot easily replace the money if it's lost, they cannot afford to lose their account capital at all. If the money that they're trading with is so important that you can't afford to lose it, when you do encounter runs of poor performance, fear takes over. And when fear takes over, you just can't trade properly. Now, if you find that you are undercapitalized, what are your options going forward? Give up? Get a better job and earn more money to fund your trading? Get financially backed by someone who does have enough capital? Well, maybe, but there are a few alternatives to consider. Number one, reducing your risk per trade. Reduce the number of ticks or pips that you risk per trade is one option, and many try this. The issue with this course of action is that although it's important to optimize risk, tightening your stops up too much will lead them getting hit more frequently and a reduced win rate. But it is essential that you assess your strategy and how it fits in with the normal ebb and flow of the market that you're trading. Reducing the number of contracts you trade with is a good option. However, it's not one that's available for many traders. Most people starting out don't have vast amounts of risk capital they're able and willing to lose. So people often start with enough capital to trade one lot. This in itself has problems, and it's likely to be easier for someone to trade with at least 2 or 3 lots. The main issue here is that you cannot reduce your trade size any lower if you are trading one lot. If you can reduce the number of contracts you trade to bring your risk down to 2% or below, that is something that you'd be wise to consider. If not, going to a smaller product, such as a CFD or an FX product, or finding a market with lower volatility can be another effective way to reduce your levels of risk per trade. And if you do choose to trade a CFD or an FX product, you should consider how the different execution may affect your performance. If you trade a less volatile market, consider whether it's a good fit for your strategy, and of course, you have to backtest that. In either case, finding the right product can be a critically important step towards fixing undercapitalization and trading success. Number 2, protecting your equity curve. This is essential to achieving trading success. By being clear on exactly what your setups are and what their historical base risk is, and adhering to your trade plan, your equity curve actually means something rather than being just a combination of the results of random trading. Too much, and you risk giving decent profits back. Too little, and you risk cutting trading short when conditions are ripe for your strategy. It's also important when you're trying to obtain consistency to make sure that you always take your setups accurately and never take setups outside of your trading plan. Taking questionable setups or setups outside of your plan, it may seem like a good idea at the time, but unless you are thoroughly prepared for them, there's a huge danger. When they go wrong, that chimp brain of yours will go bananas. You will also render your equity curve meaningless apart from telling you what your overall change in account capital is. Taking trades outside your plan means that the results are a combination of strategies, and you'll not be able to know with any degree of accuracy what the performance of each strategy has been. If you do intend to trade multiple strategies, you must tag each trade with its strategy type in your trade log. Practice. There's nothing worse than seeing your equity curve take a dive because of either taking a trade by mistake or a fat finger error. Make sure you know your trading strategy and your trading platform like the back of your hand and that you can execute it properly every single time. Find the best time to trade. Blindly trading a strategy without respecting that certain conditions are more conducive to it making money than others is not good at the best of times. It's even worse when you're on the outer limits of your trading capital. It's just as important to find the worst conditions as it is to find the best conditions. So be specific about when you trade. And there are plenty of ideas to consider in looking for the trading sweet spot for your strategy. But it's usually best to start with getting the basics right. To begin with, you can look at how the performance of your strategy varies throughout different times of the day. You might find poor performance at lunchtime or better performance at the close than at the open, for example. Now, this might seem obvious, but finding the precise figures can help you determine when you will and when you won't trade. It is important, however, to consider 2 factors when looking at the time of day performance. Number 1, your trade log stats are not a good basis for this investigation. You might not trade the whole session, and earlier trades are also likely to impact whether you take later ones or not. Manually backtest a strategy, and in doing so, take every single valid trade. And this will give you a better set of data to work with. And the second point is that big economic releases can really skew when a strategy works and when it doesn't. And fortunately, it's not too difficult to find historical economic calendars on the internet. Although that task is somewhat boring, it is well worth doing so in order to accurately complete this investigation. Define the volatility you will trade. Spikes in volatility are easy to see, and a lot of traders with smaller accounts do recognize that there's often a need to back off trading when markets are getting crazy. But it's just as important to look at what the minimum level of volatility you require to achieve good strategy performance is. When you trade markets that are too quiet, many strategies just don't perform well. Again, backtest your strategy, see how it fares. Define the type of activity you will trade. It can also be very revealing to investigate what the performance of a strategy is relative to what the market is doing. Some strategies do well when a market is balanced, and some do well when a market is trending, but many don't do well in all types of conditions. Targeting the right conditions for your strategy can help take it to the next level. And that chimp within, that primal part of your brain, will take hold if it feels uncomfortable and that it might be under threat. Emotions are then exaggerated, mistakes are made. You, the human, are left with only guilt, regret, and a big hole in your trading account. Excited chimps urge you to take extreme and often irrational action. That's not the sort of thing generally associated with successful trading. If you have a tendency to let your chimp mind get the best of you, it is critical for you to take full responsibility, do all that you can do to mitigate that issue. And undercapitalization is often a big part of this problem.